Imagine opening your retirement portfolio at age 70 and discovering that $675,000 is simply missing. It wasn't lost in a sudden market crash, nor was it spent on bad investment. Instead, it vanished pennies at a time, drained by a single tiny digit hidden deep within your portfolio's fine print. Most Americans believe a 1% financial advisor or mutual fund fee is a bargain for peace of mind. But the brutal math of compound interest reveals a dark side that the financial industry spends billions to keep quiet. If you want the real story behind money, subscribe. Let's get into it. Consider a concrete example to see how this quiet drain happens under your nose. Sarah is a 30-year-old professional who decides to invest $100,000 for her retirement. She chooses a standard, actively managed mutual fund, comfortable with its seemingly modest 1% annual fee. Over the long term, the US stock market has historically returned an average of about 8% per year. With untouched compound growth, Sarah's initial investment would swell to over $2,100,000 by age 70. However, that advisor's fee drags her actual annual return down to 7%. At 7% growth, her final retirement balance stops at just $1,497,000. This simple subtraction did not cost Sarah 1% of her wealth. It cost her $675,000. More than 31% of her entire lifetime accumulation was quietly diverted to the fund manager. To understand this staggering loss, we have to look at how fees compound. When you pay a fee, you forfeit not only the cash but also the future growth that cash would have generated. It is the equivalent of a farmer who must hand over a portion of his seeds every single spring. While the loss seems negligible in the early years, the long-term result is a massive ghost harvest that never exists. The financial industry thrives on a psychological blind spot known as exponential growth bias. Because our brains evolved to think linearly, a 1% fee feels like a minor convenience charge. We are accustomed to paying one-time transaction fees on retail purchases without much thought. But a management fee is a recurring tax levied on your entire accumulated wealth year after year. Even when the market declines and your portfolio loses value, that fee is still collected. In a year where your investments drop by 10%, the fee pushes your actual loss to 11%. The investment company secures guaranteed profit while you carry all the downside risk. Furthermore, these charges are extracted silently before your quarterly statement is even generated. You will never receive a bill in the mail or write a physical check for this service. This friction-free deduction ensures the cost remains out of sight and out of mind. The devastating impact only becomes clear when you prepare to live off the remaining nest egg. Let's look at how this fee is actually assessed, because the mechanism is intentionally obscured. Meet Sarah, a 30-year-old saver who just reached a milestone of $100,000 in her retirement portfolio. Sarah is pleased with her mutual fund, which charges a seemingly harmless 1% assets under management fee. She assumes this means she pays 1% of the profits her investments generate each year. In reality, the fund manager takes 1% of her total balance, regardless of whether the fund gains or loses money. If the market drops by 10% and her portfolio shrinks, they still extract their full fee from her remaining capital. Let's look at what happens in a flat year where her investments return exactly 0%. While Sarah's investments stagnate, the 1% fee quietly drains $1,000 directly from her principal. That $1,000 is gone forever, stripped of its ability to grow when the market inevitably recovers. Now let's run the math over a 30-year timeline, with a standard 7% average annual return. If Sarah chose a low-cost index fund charging 0.1%, her initial $100,000 would grow to over $737,000. But with the 1% fee, her net return drops to 6%, leaving her with only $574,000. That tiny 0.9% fee difference cost Sarah more than $162,000 in lost retirement savings. The financial institution didn't just take 1% of her money, they claimed over 22% of her ultimate wealth. This staggering loss is driven by the law of missed compounding opportunities. Every dollar paid in fees today is a dollar that cannot double for you over the next decade. At a modest doubling rate, that lost $1,000 fee today becomes a $16,000 deficit 40 years from now. This is why the finance industry heavily promotes the assets under management or AUM fee model. As your savings compound and grow, the administrative work required to manage your index fund remains identical, yet the fee you pay rises exponentially, turning a simple maintenance service into a royalty on your life savings. Beyond the AUM fee, there are often secondary fees hidden in the fine print of your 401k. Many workplace retirement plans charge additional rep fees to cover administrative costs. These administration fees can quietly add another 0.5% to your annual cost of investing. They are usually disclosed in dense multi-page prospectuses that the average investor never reads. The Employee Benefit Research Institute shows that these fee structures disproportionately harm workers at smaller companies. Employees at small businesses often pay twice as much for the same mutual funds as workers at large corporations. Over a career, this structural disadvantage quietly drains tens of thousands of dollars from middle-class wealth. Yet the industry resists simplifying these disclosures because complexity protects their profit margins. They count on the psychological trick of small percentages to keep you from moving your money. By recognizing this math, you can begin to audit your accounts and stop the quiet drain on your future. The machinery of wealth extraction does not operate through sudden dramatic market crashes. Instead, it relies on a slow mathematical drip that remains invisible to the untrained eye. To see this mechanism in action, we can track a single one-time investment of $100,000 left to compound for 40 years. We will assume a standard average annual market return of 8%. In a world completely free of administrative friction, that initial balance would grow to a staggering $2.17 million. Every dollar of profit remains in the account, generating its own future returns. Now we can introduce a seemingly minor variable, a persistent annual asset management fee of just 1%. Under this fee structure, the final retirement nest egg reaches only $1.5 million. That single percentage point has cost our hypothetical investor over $670,000. A third of the potential wealth was quietly harvested before it could ever reach the retirement account. Most investors assume a 1% fee means they lose only 1% of their money. The reality is that you are losing a massive portion of your final growth, not just your principal. This discrepancy occurs because money taken out for fees in year 1 is denied the chance to compound for the next 39 years. Every dollar removed today represents several dollars of lost future growth. Think of your retirement fund as a tree, and early fees as a gardener who trims the roots rather than the branches. By shrinking the root system, you permanently stunt the maximum height the tree can ever reach. What makes this process particularly insidious is that management fees are assessed on your entire account balance regardless of performance. The fee is not a tax on your capital gains, but a levy on your raw savings. If the stock market remains completely flat for a year, the fund manager still deducts that 1%. Consequently, your flat year is transformed into a net loss of $1,000 on a $100,000 portfolio. Wall Street marketing departments deliberately frame these charges as a percentage of assets under management to minimize their perceived impact. They want you to compare 1% to a standard restaurant tip. Yet a restaurant tip is a single transaction paid for completed service, not a recurring fee on your entire net worth. If your doctor charged you a percentage of your health every year, you would immediately look for an alternative. This pricing model creates a fundamental misalignment of incentives between the provider and the investor. The firm is paid based on the volume of assets they control, not on the quality of the financial outcomes they produce. The financial services industry defends these costs by promising that active management will outperform the general market. They claim their specialized research and trading strategies justify the premium price tag. However, decades of independent data paint a remarkably consistent and contrasting picture. The SFIVA scorecard tracks the performance of active fund managers against their benchmark indices year after year. Their findings show that over a 15-year horizon, more than 90% of active large-cap managers fail to beat the S&P 500. Investors are essentially paying a premium fee for a high probability of underperformance. In the world of investing, you do not get what you pay for. Indeed, higher costs frequently lead to inferior net returns. The more friction you introduce to the compounding process, the less wealth you ultimately retain. Fortunately, the rise of low-cost index funds has democratized access to highly efficient investing. These instruments bypass active managers entirely to replicate the performance of the broader market. Instead of a 1% fee, a modern index fund might charge an expense ratio of just 0.03%. This reduces the fee drag to a negligible level, leaving your capital fully intact. By switching to these low-cost options, nearly the entire market return is allowed to compound directly in your account. The savings over a lifetime of investing can easily fund several years of retirement. The primary battleground for these fees is often the employer-sponsored 401k plan. Because employees are limited to a curated menu of options, these plans can house highly expensive mutual funds, Furthermore, administrative and record-keeping fees are frequently layered on top of the individual fund expense ratios. These hidden operational costs are passed directly to the plan participants. To find the true cost of your investments, you must look beyond the simplified performance charts on your dashboard. The actual expenses are often buried deep within the regulatory documents of the plan. These fees are not deducted in a single annual charge that would trigger an alarm for the investor. Instead, they are calculated daily and subtracted directly from the net asset value of the fund. This daily extraction means you never write a physical check or see a separate debit transaction on your bank statement. The fee simply manifests as a slightly lower daily performance return. The industry term for this ongoing operational cost is the expense ratio. Understanding this metric is the single most critical step in evaluating the efficiency of your portfolio. In the United States, employer plans are legally required to provide an annual fee disclosure document known as the 404A5 statement. This document lays bare every fee, charge, and administrative expense associated with your account. Your immediate action step should be to retrieve this document from your online portal and locate the expense table. Look for any fund with an expense ratio exceeding 0.5%. If high-cost options dominate your plan, you can lobby your HR department for better choices or focus your contributions on the lowest cost index fund available. Alternatively, you can utilize an individual retirement account to gain access to cheaper funds. Reclaiming your compounding power from unnecessary fees is the closest thing to a free lunch in personal finance. Once you eliminate the drag, your wealth can compound at its true, unhindered potential. This daily drag on your portfolio is never billed to your credit card or deducted from your bank account. Instead, the fund company quietly shaves it off the net asset value before you see the daily price. You only see the net returns, creating a friction-free extraction system that keeps most investors completely in the dark. It is the ultimate form of financial sleight of hand. Consider a practical example: a 30-year-old worker who starts with $100,000 in their retirement account, earning an 8% average annual return. That account grows to over $1 million by age 60. However, if we introduce a seemingly tiny 1% annual fee, the net annual yield drops to 7%. That single percentage point reduction shrinks the final balance to roughly $761,000. In this scenario, you did not just lose 1% of your money, you lost $245,000 of potential wealth. Over 30 years, nearly a quarter of your total savings is gone. This devastating impact is driven by the opportunity cost of lost compounding. Every dollar extracted for fees this year is a dollar that cannot earn interest next year or any year after. You are not just paying the fee itself, you are forfeiting every future dollar that those fee payments could have generated. Over time, the compounding curve is systematically flattened. Wall Street advisors often defend these fees by claiming that active management can outperform the broader stock market. They display complex charts showing brief streaks of market-beating performance, but the S&P Indices versus Active Scorecard, or SPY, consistently shows a much harsher reality. Over a 15-year period, more than 90% of active stock fund managers fail to beat a simple index fund. This means you are paying premium rates for active management that statistically underperforms a basic market average. You are literally paying extra to receive less. This structural conflict of interest is built directly into how the financial services industry is regulated. Most savers assume their advisor is legally required to act in their best interest, but that is frequently false. Unless an advisor is registered as a fiduciary, they are only bound by the suitability standard. This lower legal standard merely requires that a recommended investment is appropriate, not that it is the best or cheapest. Under this suitability rule, an advisor can recommend a fund with a 1% fee because it pays them a commission. They are permitted to ignore an identical cheaper fund that pays them nothing. These commissions are frequently funded by 12b-1 fees, named after a section of the Investment Company Act of 1940. These are annual distribution fees tacked onto your expense ratio to pay the person who sold you the fund. Essentially, you are paying your advisor's marketing costs out of your own retirement nest egg. The system uses your own capital to acquire more clients for the brokerage firm. Within employer-sponsored 401k plans, the layers of hidden fees can become even more complex. Beyond the mutual fund expense ratios, plans often carry administrative, record-keeping, and trustee fees. Federal regulations require employers to provide a fee disclosure document, commonly known as the 404A5 statement. Yet, these disclosures are often written in dense legalese and hidden deep within online portals. According to research from AARP, more than 70% of 401k plan participants mistakenly believe their accounts are completely free. The lack of a physical invoice creates a powerful illusion of zero cost. If a business partner demanded 30% of your profits while taking 0% of the risk, you would reject the deal instantly. Yet millions of retirement savers accept this exact arrangement without realizing it. Because these fees are charged as a percentage of your total assets rather than your profits, the management company gets paid even when your portfolio loses money. During a market downturn, the fee eats a larger share of your remaining wealth. Let's look at another example. Sarah, who saves $500 a month for 35 years. If she invests in a low-cost index fund with a 0.05% fee, she accumulates over $730,000. If Sarah uses an advisor charging a standard 1% assets under management fee, her final balance drops to $580,000. That single percent costs her $150,000. Furthermore, Sarah must still pay taxes on the remaining balance if it is held in a traditional pre-tax account. The fee took its share of the top, leaving her with the entire tax liability on a depleted principal. This explains why the compounding of fees is often called the mirror image of compound interest. While compound interest builds your wealth exponentially, compounding fees erode it with the exact same mathematical velocity. Vanguard founder John Bogle famously referred to this phenomenon as the tyranny of compounding returns. He warned that investors put up all the capital and take all the risk, while financial intermediaries take a third of the return. To take control of your financial future, you must first locate your current expense ratios. You can find these percentages on your quarterly statements or by searching the ticker symbols online. Specifically, search for the line items labeled gross expense ratio and net expense ratio. Any fund with an expense ratio exceeding 0.5% warrants immediate scrutiny. Switching from high-cost active funds to low-cost broad market index funds is one of the simplest ways to boost your lifetime returns. It requires no speculative stock picking or market timing. By keeping your fees near zero, you ensure that the vast majority of the market's return stays in your account to compound. Your money finally works entirely for you. Understanding this math transforms you from a passive consumer of financial products into an active protector of your wealth. The difference between a comfortable retirement and working extra years is often just 1%. Consider Dave, who has diligently built a $500,000 nest egg over 25 years. He feels secure believing his portfolio is fully working for his future. When Dave looks at his statement, a 1% annual management fee seems like a trivial cost of doing business. He assumes it only takes a small bite out of his annual profits. The harsh reality is that this 1% is calculated on his total asset value, not his investment gains. Every single year, the fee is deducted regardless of market performance. Even during a market downturn, when Dave's portfolio drops in value, the fund manager still extracts their full percentage. You are paying them to lose your money. In a flat market year, a $5,000 deduction is carved straight out of Dave's principal balance. That cash is permanently removed from his wealth-building machine. This missing $5,000 can never compound or generate dividends again. Over the next 3 decades, that single lost payment would have doubled multiple times. Think of it as a toll road where the collector takes a percentage of your cargo at every single gate. By the time you reach your destination, the truck is significantly lighter. Wall Street relies on this mathematical illusion to keep retirement savers quiet. They know most investors cannot easily visualize the compounding effect of fees over decades. Beyond the basic advisory fee, mutual funds often layer on hidden costs like 12b1 marketing fees. These charges are capped by law at 1%, but they compound silently. This means Dave is directly subsidizing the advertising campaigns used to recruit new investors to the fund. His savings pay for the billboards that recruit his replacements. Then come the internal transaction costs, which are completely separate from the advertised expense ratio. When managers buy and sell stocks, the portfolio incurs brokerage commissions. A fund with a high turnover rate can easily generate an extra 0.5% in hidden trading costs. These expenses are subtracted directly from the fund's net asset value. To find these hidden drains, you have to dig into a document called the Statement of Additional Information. Financial institutions are not required to highlight these figures on your main dashboard. Active managers justify these high costs by promising they will outperform the broader market. They claim their expertise protects your capital during volatile economic cycles, but the historical data tells a completely different story. The S&P Global SPIVA scorecard shows that 90% of active managers underperform their benchmark over 15 years. You are essentially paying a premium price for a service that statistically yields worse results than a cheap index fund. The math is stacked against active management from day one. This fee drag is why legendary investor John Bogle championed the low-cost index fund. He realized that in investing, you get what you do not pay for. By mimicking the market rather than trying to beat it, index funds eliminate the need for expensive research teams. This slashes the expense ratio from 1% down to 0.04%. On a $500,000 portfolio, that drops the annual fee from $5,000 to just $200. Suddenly, Dave keeps 99.96% of his growth. Over a working career, this tiny adjustment saves Dave more than $250,000. That is enough capital to fund several years of comfortable retirement. However, the financial industry has adapted by launching high-fee index products to confuse consumers. Some brokerages charge 10 times more than their competitors for the exact same market tracking. An investor must specifically check the net expense ratio of any fund before buying. Do not assume a fund is cheap just because the word index is in the title. Another common trap is the target date fund, which is the default option in many employer 401k plans. These funds automatically reallocate assets as you age, but charge a premium for the convenience. Many target date funds simply bundle other underlying funds and tack on an extra layer of administrative fees. You are paying a fee on top of fees for a basic asset allocation. You can easily replicate this glide path yourself using a simple 3-fund portfolio. Doing so cuts out the middleman and secures thousands of dollars in savings. Corporate retirement plans are notorious for offering limited high-cost investment menus. Small business plans are particularly vulnerable to these inflated fee structures. If your employer's plan only offers expensive mutual funds, your match might be entirely consumed by fees. You must evaluate the plan's overall cost structure to protect your contributions. Lobbying your human resources department for lower cost options is a powerful but underutilized strategy. Many companies will update their offerings if employees present clear cost comparisons. The difference between a comfortable retirement and working extra years comes down to these tiny details. Protecting your principal from constant erosion is the ultimate wealth habit. To truly secure your financial independence, you must master the art of asset location. Let's look at how tax track can compound the damage already done by management fees. To escape this silent drain, the solution isn't to stop investing, but to change where your money sits. Transitioning from actively managed funds to low-cost index funds immediately slashes your fee drag. A standard index fund tracking the S&P 500 carries an expense ratio of just 0.03%. That means instead of paying $10,000 a year on $1 million portfolio, you pay only $300. The remaining $9,700 stays in your account, compounding year after year to build your wealth rather than the brokers. Over 30 years, this single pivot preserves hundreds of thousands of dollars. Many brokers will warn you that passive index funds cannot outperform the market. They omit the fact that after fees, over 90% of active managers fail to beat the index anyway. You are essentially paying a premium price for a service that historically underperforms a basic market matching basket. It is a wealth-building paradox where paying less actually yields more. Consider Sarah, who moved her $250,000 nest egg out of a 1.2% fee mutual fund into a 0.05% index fund. Within a week, she halted a fee leak that was on track to consume $80,000 of her future growth. This transfer doesn't require a financial advisor or complex trading software. Most major brokerage firms allow you to execute this transition online with just a few clicks. Before you make the switch, however, you must be aware of potential tax implications in taxable accounts. Selling mutual fund shares can trigger capital gains taxes, which requires a calculated strategy. For tax-advantaged accounts like a 401k or an IRA, these asset adjustments can be made without triggering any immediate tax penalties. This makes retirement accounts the easiest place to start optimization. If your employer-sponsored 401k only offers expensive fund options, you still have leverage. You can lobby your HR department for lower-cost options or focus your contributions to get the employer match before investing elsewhere. Every dollar saved on fees behaves exactly like a dollar earned in market returns, except it carries zero risk. It is a guaranteed return on investment that no market volatility can take away. By minimizing the fee drag, you allow the mathematical engine of compound interest to run at maximum efficiency. Your retirement timeline accelerates simply because you stopped funding someone else's. Do not let the complexity of financial jargon intimidate you into accepting the status quo. The financial industry relies on this intimidation to keep their highly profitable fee structures intact. Taking control of your fee structure is the single most impactful action you can take for your retirement portfolio today. It requires a few hours of audit but pays dividends for the rest of your life. Wealth is not built by chasing volatile hot stocks but by defending the gains you already have. Protecting your portfolio from unnecessary fees is the cornerstone of quiet, lasting abundance. When you look at your portfolio statement next time, don't just look at the return percentage. Look for the expense ratio column, calculate the dollar amount, and realize what you are giving up. The math is clear. Keeping your fees under 0.1% is the simplest way to rescue a third of your retirement nest egg. The choice to protect your hard-earned savings is entirely in your hands. If this breakdown helped you see through the industry's hidden fee trap, hit the like button so we can help more future retirees protect their wealth. Share in the comments below what is the highest expense ratio you found in your portfolio. To keep uncovering the quiet truths about building lasting, stress-free wealth, subscribe and join our community of smart investors. Let's build wealth slowly, steadily, and deliberately. In our next episode, we will expose the 3 tax traps that can silently shrink your Social Security benefits. We'll see you there.